Hi, thanks for attending this presentation on enhanced balance sheet management. My name is Carlos Herrero. I am Master Principal Sales Consultant in Oracle Financial Services, and I am very glad to have Brad Bruction participating with me in this presentation today. Brad is Senior Product Manager in Oracle Financial Services and leads both our balance sheet management offering as well as our asset liability management solution. Let me start with a very practical comment. We are constrained by time in this presentation, so there is a lot behind what we're going to present today. Please feel free to reach out to us after the presentation if you want to further discuss any of the points that we're going to talk about in the next few minutes. We can start by talking about a number of challenges that we see banks are facing, and this is based on our conversations in the industry with both current clients as well as with prospect clients. The obvious challenge is, of course, coronavirus. COVID-19 has already hit the quarterly financial results published by banks, and the generally accepted expectation is that um, this does not stop here. COVID-19 related problems for banks have only started. Reported losses so far have mostly been through increases on accounting reserves, on the provisions for loan losses, calculated based on expected future credit losses. And in addition to this, levels of non-performing loans are expected to surge in the near future as delinquencies and actual defaults will increase. This creates a number of problems for banks, obviously. And one of the problems is about being able to take the right decisions on how to manage their balance sheets and therefore how to manage their banks going forward. Just to mention a couple of examples, bank will need better ways to identify those clients and products that will remain highly profitable despite the crisis. Banks will need to manage their credit origination strategic decisions very, very carefully. And this is a very challenging situation, which actually adds to a number of serious difficulties that banks were already facing 1 year ago. Especially in certain geographies, authorities had already repeatedly warned banks about their low profitability margins in an environment of low or negative interest rates and with increased competition from new entrants. When you consider all these elements, this is a really challenging business situation. However, we also see a number of new possibilities, new developments that have emerged or have developed over the last few years. We see the combination of three enablers for banks: data, methodologies, and technology. First, in terms of possibilities provided by data, an increasing number of banks are taking decisive steps towards leveraging on the large amount of data they have about their clients. Number two, methodologies. Banks can now leverage on the highly sophisticated and efficient machine learning and artificial intelligence techniques that have been developed in the last few years. And finally, number three, technology. Banks can use cutting edge, modern, high performance computing technologies. So yes, computing performance has been enhancing relentlessly for many years. The big difference now is that these technologies can now be accessed on cloud computing using a pay-per-use model. Say, for instance, that in order to produce computer-intensive balance sheet projections, the ALM or the Treasury Department needs to use a large number of cores in a big data-enabled high-performance computing environment. But the thing is that they need to do this 1 day per month only. And in this case, I do not need and I do not want to buy and install a large grid of CPUs, as it was the case in the past. Now the department, ALM or Treasury, can subscribe to Oracle Cloud Infrastructure and pay only for the time they need and for the resources they consume during that time. This is a big game changer. And going back, if we consider the combination of these three elements, data, machine learning, and access to high performance computing, that allows banks to apply accurate granular behavioral models, I think credit models, prepayment models, precise models to understand in detail their retail funding. Think of, for instance, probability distributions of macroeconomic projections that can inform credit models, or automated predictions of new sales projections for each one of these macroeconomic projections. Yes, it gets a little bit complicated, but I think that for those of us that have been working on balance sheet management, I think that we know these kind of complicated scenarios are things that we want to manage and we want to solve. But in any case, what does all this mean in terms of enhancing balance sheet management processes within banks? Which are the benefits that we take from this? First of all, we're talking about better balance sheet management enabled by more detailed, more granular, more accurate, and more reliable analytics. This will allow banking executives and senior management to take better informed decisions. We want to help banks to successfully navigate through what is otherwise a very challenging business environment. And we can talk, for instance, about enhanced risk-adjusted performance optimization across a number of different forward-looking business environments. And we could talk about other examples as well. But the next question is, how can banks enable enhanced balance sheet management by making use of these three possible, all these possibilities and opportunities? And let me answer this question in the context of the Oracle Financial Services Risk and Finance Platform, which is used by literally hundreds of banks throughout the globe. Let's consider the end-to-end calculation flow in a risk and finance calculation platform. This is what you see in the screen, and in the screen, obviously, you see a largely simplified representation of such a platform, but it will be useful for me in this context to comment on a couple of insights. The flow starts with the ingestion of input data such as contract terms and conditions, customer characteristics, accounting ledger data, market data, etc. Then we have a number of different well-orchestrated calculation engines that work in the production of the results and write these results in a results area. In the case of a balance sheet management context, we may be talking about accurate balance sheet projections across the scenarios and applying different business assumptions. Then reports can be produced using these results. We are talking about results dissemination across different departments and different groups in the bank to inform decision-making executives, to inform the board, to inform analysts, etc., etc. This end-to-end process, though, needs a robust, modern, scalable underlying infrastructure. It needs full data governance capabilities, model governance managing the full model lifecycle, as well as flexible business intelligence reporting layer. In short, it needs full BCBS 239 risk data aggregation compliance. Also, we need the platform to support both relational databases as well as file systems when the bank uses big data. And finally, there should be the option to deploy this platform, or at least part of it, not only on-premise, but also on the cloud, so as to leverage on the benefits of cloud usage, as we mentioned on the previous slide, right? Now, going back to the engines, we have some existing engines in the platform that provides some native capabilities: ALM, asset liability management, liquidity risk management, funds transfer pricing, profitability, balance sheet planning, cash flow engine, CISO, IFRS 9, etc., etc., etc. What we do is we extend the capabilities of those engines by using the machine learning capabilities that are provided by the model management and governance solution that also sits in the very same platform. So we can then provide machine learning behavioral models, prepayment models, non-maturing deposits modeling, etc., to ALM, to FTP, to liquidity risk management, etc. We can provide forecasting models, forecasting of market factors, of macroeconomic variables, of new production for the banks, for the balances by book for the banks, etc. We can provide credit models, probability of defaults, LGDs, transition matrices, and these are all only some examples on how we extend the capabilities of our models. Of our existing calculation engines using these models, these machine learning models, and this is something that we are already doing today. Now, in terms of how are we going beyond our current capabilities, I'm going to ask Brad to comment on some exciting new developments that our product management group is working on. Brad?
Yeah, hi, Carl. Thank you. This is Brad Brookson. I am, as Carl said earlier, I'm product management for asset liability management and the balance sheet management suite of products. So some of the things that we're getting into new, as Carl was stating, that, around the modeling of artificial intelligence and machine learning, he stated in terms of, some of the possibilities, back to the first slide, of leveraging large amounts of data and getting accurate and granular behavioral models, in addition to high performance computing, right? So we're doing what we're good at. We're taking all of that into consideration and basically creating or giving the users ability now to do, their own prepayment modeling through the application, but also into the historical data that they've collected to get accurate results, right? So one of the things we're delivering is a prepayment model. Another is around deposit and non-maturity. So getting into the non-maturity type of modeling, we're allowing the core and volatile definition and looking at then the decay on the core amount, and then calculating a beta and a rate stickiness. All of this, which comes together in the application, and we apply these to the cash flows then as we go forward. Another thing that we're looking at in terms of forecasting, what we call predictive or autonomous forecasting, which is basically we have, again, this is a form of machine learning where we have all of the existing positions, we have the data, we have the historical amount, the historical data there by basically at an instrument level. So we can now intelligently predict what a balance sheet might look like, 3 years forward, n number of years forward from say a static basis. So let's say the objective is I want to look at my NII over 3 years on a flat balance sheet. So what I have today, I want to roll the positions. I can now intelligently price that. I can intelligently create and roll those positions forward based on the knowledge that I have within my book existing. Another thing that we're looking at is increased accuracy, right? So what we've done is completely rewritten the cash flow engine from the bottom up. So some of the interesting thing or things that we're delivering in there, which are pretty big changes comparatively. One is a daily rate forecasting. So what does that mean? That means into the forecast, I have a daily rate stream. I don't just use, say, monthly rates or rates, one rate per month or one rate per bucket. Every rate per day into my forecast for 30 years forward, I can produce different rates. And what does that really allow me to do? That allows me to get better cash flow precision around my cash flow modeling, right? So in other words, if I'm forecasting for n number of periods and I have new business coming on or I have repricings occur, they're going to get a different rate for each day based on whatever forecast scenario I've done, right? Cash flow precision. This is also where we're getting into more granularity within that. Basically streamlining the interest only, principal only, or combination thereof cash flows to allow better forecasting based on that, and better even for the existing position and the forecasting as well. As far as from a new business perspective, this is something we're also excited about, introducing what we call a planning tree. So this is really going to allow more flexibility into how we plan based on our product hierarchy now. So it's going to give us greater dimensionality and greater flexibility from our existing positions, how we plan, and overlaying, greater detail into that plan. Another piece within the application itself is within the IRC interest rate curve construction itself. So a couple things going on in there is that we're allowing more sophistication in terms of the term structure. So in other words, allowing the yield curve attributes to be defined at a term point level, not just at the curve itself. So if you have, say, a hybrid curve with, short end may be ZCY, long end might be YTM, and different compounding basis and accrual basis, all of that can be set at the term point level, right? So now we have the ability to better forecast and do rate conversions and implied forward sort of calculations at a more accurate basis. Last is something in what we call managed rate functionality. So this directly relates back to our deposit analysis where we talk about beta. Really the primary use case here is taking what we call like an equation-based rate. So what I want to do is say if I find out my beta on my deposit book moves at 40% of the rate of a 1-month LIBOR, let's say, right? I can define that curve in my managed rate functionality and apply that to my deposit book such that when I forecast my 1-month LIBOR rate, my managed rate follows accordingly based on that equation that I've laid out. And also getting into this, there's kind of what we call the new look and feel, right? So I talked a little bit about rewriting the cash flow engine from the bottom up. Another thing that we're doing with the cash flow engine in and of itself is releasing it as a standalone application. And so right now the cash flow engine is integrated with many of the applications, asset liability management, balance sheet planning, funds transfer pricing, etc. We're also find the need to have, or we also found demand for larger banks, other banks that don't have the ability to produce cash flows at an instrument level, that they have the need for just a standalone cash flow engine to do other things within the bank, be it modeling, be it regulatory reporting, et cetera, et cetera. So because of what we've done with engineering this and how we put it together, we're going to release it as a standalone product, both on-premise and on cloud SaaS type platforms. Other things we're working on is increasing or improving, I should say, the ALM and balance sheet management reporting. So streamlining the data movement process and really enhancing the reports that are there to really give that clear view of risk and profitability. And finally, putting this all together, updating, really updating and improving our user interface to bring it more into the 21st century, much more user-friendly. We're embedding instant gratification in terms of things that are done. So we embedded objects to show you what's been done, or even reports and graphical reports based on things that you've set from a metadata perspective. So these are just some of the things that we're looking at doing, or that we're doing and delivering on our roadmap as we extend, leveraging again the Oracle technologies and the ability to kind of handle all these data volumes, fast processing, and so on. I hope you enjoyed and found some of this useful. Thank you for listening to this presentation. And if you have any questions, please feel free to reach out. Thank you.